The Good afternoon, everybody, and welcome to Rotherby Racecourse. To go through the agenda for this afternoon, we've had a slight switch round, so I'm delighted to welcome back Luke Pearce from Rowan Dartington. As a lot of you will know, is the stockbroking arm of St James's Place. Luke will be reviewing the markets for us over the last 12 months, having a bit of insight into the impact of inflation and interest rates, and giving us a bit of insight into where the rest of the year may go. And then after that, Richard will be going through the budget and picking out the main points with that. And then we've got a general update for you, which is really regarding everything that's been in the press regarding St James's Place, and just to give a bit more clarity around that for you. At the end of that, if anybody's got any questions, if you can leave those till the end, and we can answer as many of those as we possibly can for you. Feedback sheets you've got, if you can fill those in and hand those in on your way out, okay? I'll just now hand over to Richard and we'll get started. Thank you. Oh, sorry, Luke even.
Hello, everyone. Markets. I thought the best place to start was really having a look back at what I said to you last year and which bits were right, which bits were wrong. I think the first bit stands out as being one that I got wrong, one that we got wrong, probably more from hope than anything else. I think we all hoped this time a year ago that the war with Ukraine would have finished, and it hasn't. Indeed, I'm not sure what sign there is of that immediately finishing, but that's a total other subject that I'm not going to get drawn into. From an investment perspective, the implications of the ongoing war have so far been minimal. So this time a year ago, the gas price was already down 75%. It's fallen another 60% from this time a year ago. Part of that has been down to ongoing supplies continuing, and part of that has been down to the warm winter. But looking at the other bits on there, most of the other bits panned out and had a bearing on markets last year. Some of them are still ongoing, so I'm going to have a chat about those in turn. But I think it would be good just to reflect back to how we started things a year ago. So 2022 had been a poor year for investment markets. The anticipation as we came into last year was that we were going to go into a recession, and the question was, how deep was that recession going to be? So was it going to be a hard landing or a soft landing? And how were investment markets going to perform on the back of that? So 2022 had been a negative year. Sentiment was a bit gloomy as we started things. The reality was very different. We had strong returns from investment markets, as many of you will be aware. Looking at things in totality, and this is a rather garbled chart. It looked much easier when I was looking at it on my computer. The top line is the S&P, so the 500 largest companies in America. And American companies performed pretty well throughout the year. Some of that was down to AI. Some of that was down to other reasons. I'll come on to it in a second. Europe was the second best performing area. Europe did very well last year because we had a warm winter. Again, last year, the anticipation was that we could have had a cold winter and the problems with oil and gas could have been catastrophic. That didn't happen. Europe did okay, got through the year. The end result was pretty positive. Here in the UK, it wasn't until the final quarter that we started to see positive returns. So the two lines at the bottom, the very bottom line are the Gilts All Stock Index, and the line above that is the FTSE All Share. It was the anticipation of cuts in interest rates that caused a rally in global markets, and the UK, both bond and equity markets, benefited from that. So the main drivers really were interest rates and inflation. The fear of recession, AI, and China and Japan, which I'm going to come on to in a second. Now, from an investment side of things, I suspect you have all heard far too much about inflation. It's on the way down, thankfully. It's going to be harder to get rid of the final bit of inflation. So central banks around the world have a target of 2%. It's a slightly strange figure that came from a New Zealand economic study that was written a while ago. But 2% is the global norm that central banks are trying to achieve. We're getting back that way. Supply disruptions have alleviated. A lot of excess spending from COVID has fed through the system. Excess money liquidity is tightening as interest rates rise, etc. So we've had the main battle against inflation, and that should be positive for investment markets as we look forwards from here. So inflation has been beaten. The recession side of things is really important, and there was a real fear that we were going to go into a recession last year. What tends to happen is that people tend to buy big companies. It feels safer to be in a large company when there is a fear of recession. From an American perspective, the likes of Apple, Microsoft, Amazon, they're household names. You feel as though they're going to be around, and some of the numbers behind them are phenomenal from a turnover perspective, from a size of business perspective. Nvidia now has a larger market cap than all of Germany put together. But these are big companies. In theory, they should be cash generative companies, and people sort of bought into them. Partly on that recession fear side of things. The same thing was happening from a European perspective. They didn't have 7 companies, there are 11 of them. The granolas, as they seem to have been called. But effectively, it's large mega cap companies that have been the main areas of focus for investors over the past 12 months or so. I'm going to come on to them again in a second, or return back to them in a second. The other side of things is AI, and AI, we are in theory at the start of a journey. Personally, I don't know where that journey is going to go. We were discussing AI a second ago. AI has been around for an awfully long time. One could say calculators, we have them in our mobile phones, it's predictive text, it's all of these sort of things. It's just the ongoing development of AI and whether that can be used as something to boost productivity. I think it was mentioned by the Chancellor on the budget day. AI could be revolutionary from that side of things. It gives a bit of positivity, and we really need a bit of positive news. So that's a story that has been clinging to investors, or investors have been clinging to, and I'll come on back to in a second. Now, the other side of things, China. So this chart is going back, I need to put my glasses on, somewhere around 2021. You can see the V in the middle, and I put on there that reopening rally, which was the anticipation as we came into last year through till about February. China had been in lockdowns for a lot longer than we had. The Western world, when we came out of lockdowns, everyone went in and bought things. They spent money. They'd been handed free cash, which they could go out and spend. That wasn't the reality in China. They weren't given that cash, and therefore they didn't have that excess spending. And the reopening was very much more of a damp squib rather than something exciting. That, coupled together with the fact of concerns towards what's going to happen with Taiwan, the property crisis that there is in China. China Evergrande is the one gaining the headlines, but they have a property crisis over in China, and politics. The East and the West dislike each other hugely. That's not disappearing anytime soon. It's not worth investors' risk. If you're a fund manager, it sits uncomfortably when you have a loss in a portfolio. We'll have losses within portfolios. But if you have one in something like China, it feels very uncomfortable because it feels logical. Why do you want to go and invest in there? We know that Trump and Biden dislike China. Why go and hold it? So China's reopening was poor, and the investment returns have been poor for the past year or so as well. More positively, Japan is a completely different story. So Japan was last at these levels 34 years ago, so it's taken an awfully long time for Japanese markets to recover lost ground. The recovery was sort of starting, crumbs, 5, 6, 7 years ago, Abenomics. So Abe introduced some measures to try and improve the Japanese economy, but the real transformation in simple terms, happened at the start of last year, where the Tokyo Stock Exchange effectively turned around to companies and said, we're going to name and shame you for being undervalued. So what they have in simple terms is a lot of companies there whose share prices are trading at massive discounts to their net asset value. So the value of the company, its goods, its buildings, its assets, are worth significantly more than the share price. And the Tokyo Stock Exchange said, you're going to go on a list and potentially ultimately be delisted unless you realize value for shareholders. Japanese, very proud people, they didn't want to go on a list of shame, and therefore they've gone about realizing value for shareholders through a number of different measures. The result has been that the Tokyo Stock Exchanges, the Nikkei, etc., have performed very strongly. Now, some of that has been annulled to a degree by the weakness of the yen, but they've still been one of the best performing markets over the past year or so. There are other structural changes that are happening. They're transforming they're introducing an ISA over there. Interesting, bearing in mind what happened from a budget perspective, but I'll come back to that. So that's everything that's been happening in the past. It's easy for me to do. The question is, what's the outlook? What's likely to drive things as we look forward from here? Now, from an economic perspective, our view is that we muddle through. Untechnical term, but it's a simple way of looking at things. It's not very exciting. So economic growth is expected to be somewhere between -0.5% and +0.5%. Not particularly exciting, but that's equally not recessionary. I mean, admittedly, it's not a million miles away from a recession, but it's just uninspiring. That tends to be an okay environment to be investing in, particularly when interest rates are likely to be cut, and interest rates will be cut this year around the world. Inflation is falling, so that takes away the competition for investment markets. So it's a pretty good environment. If we converge slightly more positively, then we're in a Goldilocks environment. That's falling interest rates, falling inflation, economic growth is fine. That's brilliant for investment markets. That's exactly what you want. And this year has, in fact, started very positively. If we go back to the lows of October, the American markets are up over 25%. So really positive signs from that perspective. So it's been a good start to the year. Economically, should be okay. Interest rates are a key hurdle for investment markets. They have a bearing on what happens to life and society in general. These two lines on a chart are really the anticipation as we came into this year. So the orange line was the Federal Reserve, who were turning around and saying, we predict that there will be 3 interest rate cuts in 2024. The markets in December upped things a little bit. They turned around and said, well, actually, we think there are going to be between 6 and 7 cuts next year. And to be honest, markets have got a little bit overexcited about themselves. Now, it would have been great to experience 6 or 7 cuts in interest rates this year. The problem is that we were only going to get 6 or 7 cuts in interest rates if economic growth had really weakened, and that wouldn't have been that positive for investment markets. The realization now, or market anticipations, are much closer aligned to the Federal Reserve, i.e. 3 interest rate cuts this year. 3 interest rate cuts, that would be pretty good. It means economic growth is fine. The obstacle of risk-free returns of higher rates disappears, makes it less expensive for those people who are refinancing debt, etc., etc. So there is a lot to it. From our perspective, good news to see a couple of cuts. Now, valuations are always a consideration. I might have said to you before that I like the idea of GARP investing. That's growth at a reasonable price. So you want to be investing in a company that is growing, but you don't want to be overpaying for those earnings. Now, America, you can see, has a whole load of red and orange squares. Relative to the rest of the world, it is expensive. I've been doing this for 25, maybe a bit longer, years. And America has always been expensive. It's never been cheap. Relative to the rest of the world, it's always been expensive. That being said, it's resulted in pretty good growth over that period of time. Valuations are a poor predictor of future returns. They are definitely a consideration. The last time that we had a big tech boom like this was 2000, and I was investing back then. And Microsoft's share price took 18 years to get back to the level it was at in 2000. So you need to be conscious about overpaying for things. Same thing with the bit about Japan, I would say. It's taken 34 years for investors to make their money back there. So you've got to be conscious about the price that you are paying, and diversification is really, really important. So, yeah, it's good to have some exposure to the Magnificent Seven, those 7 large cap companies in America. Last year, as I said, they drove most of the returns. So the tables on here, far right-hand side, 2022, you can see a sea of red, 2023, sea of blue, and a mixed performance this year. And I think that that is very important to note. So we're seeing this year, Tesla and Apple down at the bottom, Nvidia and Meta up at the top. Apple is suffering at the moment for a number of reasons, a large number of reasons. iPhone sales in China are down 25%. They've just been hit by a fine from the EU. There's the anticipation that Apple products aren't what they used to be. They're not as innovative. They're not improving things. So yeah, it's a cash cow. But are they going to suffer higher taxes, more ongoing fines, struggling with their Chinese business, etc.? Tesla, again, losing out in market share over in China. Now, what one doesn't want to do is group all of these companies together. So yeah, there's 7 large companies, but they are very different beasts. Nvidia are up at the top, up nearly 75% year to date. It's slightly terrifying. This chart is a couple of days out of date, and things do seem to move around really quite rapidly from an Nvidia share price perspective. The pale blue line is Nvidia's share price going back over the past 2 years. It's been on a tear. Share price was somewhere around $200. It's now somewhere around, well, actually, it's around $950, $960 at the moment. So it's risen massively. The interesting bit, I think, in my view, is the dark blue line on here. That is the PE ratio of Nvidia. PE being the price divided by the earnings. In simple terms, it shows how expensive a company is. And you can see that over at the right-hand side, sort of where we are today, the shares, despite the share price having risen, earnings have risen quicker than the share price has, and therefore the share price has become cheaper. Now, for goodness sake, don't go away from here and say that Nvidia is cheap. It's not cheap, it's just not as expensive as it has been. So it's a complicated one. I don't know what's going to happen with AI. Nvidia only forecast earnings a quarter in advance. Everyone is very positive towards them. Everyone was very positive towards Cisco back in 2000. That didn't go so well. But Nvidia has been an incredibly transformative company. It has morphed from cryptocurrencies across and into AI. It keeps on. It started off doing gaming chips before that. So vast amounts of transformation. It is something that should probably form a part of your portfolio and will do. It's a large company. Now, the other side of things is, whilst the UK doesn't represent a huge proportion of a lot of portfolios, it's important. And we live in the UK, and it's nice to have a bit of a chat about the UK. The table on the right-hand side is showing UK productivity since 2016, since the Brexit vote. Everyone turns around and says, our GDP is pretty lackluster. Yeah, it's not great relative to America, but relative to most of Europe, we're stacking up pretty well. We're doing better than Italy, doing better than Germany. France has been a slight quirk, but we're in line with France. So actually, our GDP has been fine. On the left-hand side, you can see our price-to-earnings ratio of our invested companies. They have got cheap. They're back at the same levels that they were at in 1992, so really cheap relative to the rest of the world. Now, the question, though, is, what's going to be the catalyst of a re-rating of the UK market? And I don't know. It could be the Brit ISA. I don't think it will be. I don't think that that carries enough of a punch. Now, we have management. We have great management. We have great governance. We have cash-generative companies. They have robust balance sheets. We've also seen a huge amount of corporate activity from a UK perspective. So foreign buyers, whether that be foreign financial institutions, whether it be private equity firms, they're coming in and snapping up UK companies left, right, and centre. And that's because they realise the value that is happening here. Currys, for the sake of things, recently received a bid. It has rejected that bid. That bid effectively valued the company at 0.6% of its net asset value. So effectively, the purchasing company could come in, buy all of Currys' assets, close down the business, and make, give or take, 40% more by just flogging off the assets. That shows how cheap these sort of things are. Is that going to be a big enough catalyst of change? I don't know. But if we're not careful, we're going to see foreign companies buying up a lot of our UK assets because they're too cheap. The world is a big place, and this year is a big year. So we have more elections impacting more people around the world than at any stage that has happened before. Now, some of these are foregone conclusions. So we have the Russian election cropping up in a couple of weeks' time. I think we all know what the outcome of that is going to be, sadly. There are other elections where the implications are likely to be more profound. From a UK perspective, I don't think the implications will be that profound. At the moment, the markets are very much forecasting that Labour will get in. They're also forecasting that the impact from an economic perspective will not be that significant. Either party that gets in, we know that they are fiscally hampered on what they could do when they win the next election. That was fairly apparent from the budget the other day. Over in America, we have a different position. It's looking as though it's going to be Trump or Biden, assuming that Biden can make it through to the fall. Trump is the one who's probably most interesting to have a chat about, and I am not going to verge into politics here. I'm just going to chat from an investment perspective. Trump is likely to introduce tariffs on the rest of the world. When he came into power last time, he threw a whole load of cash at the situation. So he granted tax cuts, he threw cash around. He doesn't have the fiscal ability to be able to do this this year. The budget is too tight. What he will or is likely to do is to put tariffs on foreign goods. Now, that is going to be inflationary because, generally speaking, putting tariffs on just increases the cost to people. So that's likely to be the implication. A review that I read the other day was saying that whilst that might be negative from an investment perspective, the power and enthusiasm that there is for AI, etc., will outweigh any of the concerns that there might be. We've still got a long way to go until that election. There will be a lot of heated conversation between now and then, and we'll get fairly bored of it between now and then. So we will have to wait and see. One bit that I just wanted to finish with was just do be conscious that all of this is short-term noise. And yes, we need to be conscious about what happens over the short term. But this index is MSCI All Country World Index, goes back to 1988. And there's a pretty nice curve on there. Yep, there are some bumps along the way, and COVID was definitely a bump. 2000 was a bump. 2009 was a bump. But actually, the general trend has been very positive. And it's good to think about the longer term rather than the shorter term. And that's where that power of compounding and the power of the advice that John and Richard offer you definitely makes a difference. That is it. And I was just going to make a slight change to things because Richard is going to answer questions at the end, but I'm going to disappear in a minute. If anyone's got a question from an economic perspective or a market perspective, I'm really happy to answer it now if anyone's got the courage to put their hand up. Yeah, go for it.
Do you think the British index will follow what Japan's done, effectively, by saying that your assets
are undervalued? No. I don't think we've got. I would love us to. We need to do something to reinvigorate enthusiasm, and that's not just from a stock market perspective. I think as a country, I think we need to stop beating ourselves up and be slightly more positive about things. Catalysts of change from a UK perspective, I don't think it will be the Brit ISA. I don't think that that is going to be enough to reinvigorate things. There is talk about wanting the pension funds to reinvest back into the UK. I think that that could make a big difference. I personally hoped that there was going to be more in the budget than there was. I don't want to spoil Richard's thunder because he's really only got a small clap of thunder coming out because there wasn't much in the budget. I was hoping for more and it didn't happen. Is it going to happen in the future? I can only hope that it will. But there is value here, and we are seeing takeovers happening left, right, and centre. So it's happening from that perspective. Yeah.
But do you think the defence industries in the UK, like British Aerospace, whatever, they're going mad, aren't they, on their share prices?
Yeah, they're doing. Defence is doing incredibly well. So there are pockets of things that are doing well. In totality, the index hasn't been doing well. I could go into more detail about it. I probably won't. The FTSE 250 tends to be more domestically orientated and hasn't been doing that well. We've seen a bit of a rally over the past 6 months or so, but small cap UK companies haven't been doing well. From a large cap perspective, actually the FTSE 100 is more concentrated in the top 10 than, say, America is. A lot of those are stodgy old-fashioned companies. I shouldn't say that, I'll get sued for saying that. BP, Shell, the miners, etc. A lot of those are influenced by economic fundamentals. So if economic growth is not particularly exciting, if China's not doing particularly well, then you're seeing the mining companies not doing well. They're not in. People want companies that go up 75% in a month and a half, 2 months, rather than something that takes an awfully long time to get there. Warren Buffett, an amazing long-term investor, he's just slowly compounded returns by choosing, I would say stodgy companies, but one of his largest companies is Apple. It's about getting those compounding of returns that really makes a difference. Yeah.
I want to talk about the demise of the London stock market with
Yeah.
particularly new listings. I just wanted to go any comment where you see that trend there.
There is a hope to try and get it to change. There's talk of a large new listing happening this year, which is a company I think called Shein. I'm going to be younger people. My children. I was about to dig an even bigger hole by saying, I'm not going to go down that. They sell cheap clothing, and there is a possibility that they will seek a listing here rather than America for a number of different reasons. But the reasons, on the whole, that there haven't been listings are bureaucracy, a lack of enthusiasm towards the UK, the fact that executives in America tend to get paid a shed load more than they get paid here in the UK. Those would be the main reasons why it doesn't happen. There's enthusiasm to get it to happen, but as of yet there have been more takeovers than new listings happening. Shein would be one that could be exciting. The problem with Shein is it makes... I need to go and have a look at the company. They produce Tosh. So it's Primark, but even cheaper was the way that my wife described it. Yeah. Which then brings into all of the controversies about not quite slave workshops and things like that, but it brings in all of those sort of things. So is it even the kind of company that we want listed here in the UK? But yeah, it'd be good to get more listings happening. Anything else? Having dug a whopping great hole. Thank you all very much indeed. I'm going to pass you over to Richard, who's far better at this than me.
Luke's got another commitment, so won't be rude to me. He's going to disappear. Having said that, you don't like Oh, no, I won't go. Young people's clothing. I mean, honestly, look at you. I mean, thank you. And interesting, when Luke was talking about sort of catalysts for change in the UK market, I sort of wrote down just in the last couple of weeks, there's been a takeover, a cash takeover for Sparent accepted, Wincanton transport business takeover accepted, Mondi will be in your paper tomorrow on an all-share cash takeover of DS Smith. Barrett's last week announced takeover of Redrow. Nationwide be in your papers today, taking over Virgin Money. 2 private equity bids, both rejected, 1 Direct Line, 1 Currys. That's 6 in about 2 weeks. So valuations are showing people are happy to pay. Will that be a catalyst for change? Not sure, but a lot going on. The postman hopefully will have delivered, and if he hasn't, he will. And thank you to all the team for doing such a great job to get it out. How am I going to make the budget interesting? I'm going to try and talk about it quite quickly because, as always, winners and losers. So the big winners are the workers. They've had a 2p cut in tax, in national insurance, already announced from the autumn statement, and a further 2p, so 4p in the pound cut in tax. It's quite substantial with any increases workers have got. I'm not trying to rub it in because I'll come to losers in a second, and that will happen in April 24. Child benefit, if you've got over 50,000 income in the household, you lose the child benefit. That's gone up to 60,000. ISAs, Luke's touched on the British ISA, and I'll come on to that in a second. If you have a second home and you're a higher rate taxpayer, you will pay less tax when you sell it from April. And drinkers and drivers, you're not having any more duties and everything else, so go and put some diesel in your tank and have a gin tonight or whatever. Losers, frankly, anyone that pays income tax because the thresholds are frozen. We'll talk about that. They've been frozen. It wasn't re-announced. It's just a fact. Capital gains tax, again, I'll talk about that, but that's getting worse. Estates for deceased, i.e. inheritance tax, frozen since 2009. Nothing changed. Dividend tax recipients, the dividend tax threshold for taxable portfolios is going down. Pensioners and unearned income earners, obviously, apart from the triple lock for the state pension, there was absolutely nothing in the budget for anyone of state pension age. And then, obviously, if you turn left on a plane, you're going to pay a bit more tax from April. And all of you who vape, and I know there's lots of vapors around here, you're going to have a vaping tax, which I'm delighted about. I've told my daughter all about and told her yet again to stop. And the bottom line is, the OBR, the Office of Public Budget Responsibility, confirmed it last year, reconfirmed this year, that we are, as a nation, at a state of very high levels of tax, going right back to 1948. So within 0.1 of a p as a percentage of a tax. We haven't seen that since post-Second World War British recovery. We have big government, we have deglobalization, we don't trust the Russians or the Chinese, we're making more things, we've got a bit of inflation, and boy, there's a lot of tax, and this is under a Conservative government for the last 13 years, 14 years. So let's quickly whip through the unchangeables. Nothing's happened with income tax, everyone's getting a pay increase, whether it be your state pension, your pension or whatever, and therefore your level of tax will rise. Your income will rise, but maybe in real terms as prices have gone up, the tax take goes up, even though you may have more money coming in. How much are you keeping just to keep going? The married allowance, where you can give some of your unused allowance in a marriage to your partner as long as they're basic rate taxpayer, that remains. It's a good thing to have. I had a lovely lady who told me in front of her husband she was reclaiming her married allowance as she went into state pension age, and she was proud of that, which is great. The thresholds are unchanged, so up to pretty much 50,000 from 12.5, you're at the basic rate of 20p, then you're on 40p up to 125. And anyone or anyone's children over the 100 to 125, it's a 60% effective tax, as for every £2 over 100,000, you lose £1 of your personal allowance. So anyone over 125,000 doesn't even get the personal allowance. No change again for savings rates. So if you don't have much income, you can get a bucket load of interest and not pay much tax right up to 18,500. So again, it's all about who's name, you've got your cash in and being as efficient as possible. You've got unchanged personal interest savings allowances, £1,000 a basic. If you're a higher rate over 50,000, you can have £500. And then the dividend rates, well, are actually hitting us from next April. From a month's time, you can only earn £500 of dividend income. Above that, you're going to then be paying different levels of tax. And I foresee, and it's already sort of in the papers, that there's going to be quite a lot of stress amongst a lot of pensioners where they are earning more than £1,000 of interest. If you keep this simple, if you've got £20,000 earning 5%, it's £1,000. So anyone who's got more than £20,000 of capital on deposit in taxable interest, you're going to owe some tax. And right now, one of the things I advised this morning, when you go home, look at your pay-as-you-earn coding notices, PAYE. You should all have had them in the last few weeks. And there may be some notice there that your coding has gone down a bit. You can earn less money before paying tax because you're earning interest. And that's something that you've got to watch closely, because HMRC are getting the data from banks and building societies. Are they getting it right? And are you paying the right amount of tax? Same goes for dividends as well. Once you're over next year for 500, you owe a little bit of money. So I'll talk about now ways to shelter tax. Nothing unusual. You start by in April putting as much of your taxable wealth in an ISA, whatever the ISA is, whether it's cash, whether it's stocks and shares. We've already got, they call it, everyone's calling it the British ISA, the Treasury call it the UK ISA. We've got the consultation document, 15 pages, pretty thin to be frank. Looking as though, firstly, nothing will happen straight away. The consultation doesn't even end till the 6th of June. So then there'll be a period of reflection. And I suspect just before the election, we may get an announcement. You can throw another £5,000 into an ISA. Great, fill your boots, 25,000, you might as well at that stage. All I think John and I will start to advise is if your portfolios need balancing, so there's a little bit more out of the UK, so you put a bit more in the UK, fine, go and do it. In the consultation document, and what we think will happen is like PEPs in 1987, when they started you had to have qualifying funds with either 75 or 80% in the UK stock market would qualify to represent that British share. But we've got to see what happens with the consultation document, how it's administered, etc., because what's going to stop you once you put it in, keeping it in that element, and there's all sorts of questions. But long story short, to minimise your tax liability, if you've got either interest or dividends that are generating more than £1,000 or 500 respectively, get it in the ISA straight away. Pretty much all of you've done ISAs for the current year. If you haven't, tick the response sheet and let's get it done. And for the junior ISAs or lifetime ISAs, 9,000 and 4,000 net, again, get it done. There's one big drawback. They have to get it at 18. The less say about that, the better, but there is clearly a risk at 18. That person, when they get hold of that money, are in charge of what they do with it, whatever influence you try to bring to bear. And it may sound odd, but always, you all who are under 75 can do a pension straight away. You can get 2,880 in, maximum if you don't work, but the government will give you 720. Obviously, helping children do pensions, it's immediately exempt from inheritance tax. What's in it is exempt as well. And the thing I've put down at the bottom, no probate requirements or delays, because a defined contribution pension is exempt from inheritance tax, it's effectively written into trust. We are able, on production of death certificate and claim form, and we're getting really quick and good at this, able to make sure the widow or widower or children have that money way before, in many cases, probate has even been asked for. So one of the advantages of defined contribution pension schemes is that portability at the point of death into the next generation or the spouse. And that's not really written up enough and needs to be. It's not going to save you income tax, but it is something crucially important in later life. I talked about the pensions. So the tax efficient moves, are the normal ones. I won't overdwell. Anything, look at your wealth. You can't do anything about your fixed income from pensions. You can do things from your taxable wealth, whether it be in banks, building societies, shares or whatever. That's where you've got to look at minimising. Venture capital trusts and EISs are quite specific, and we talked about the pension. So a range of things to do and to utilise. Now, just when you thought there's nothing much going on, let's have a real stab here. Capital gains tax. 12,300 last year, 6,000 exemption this year, 3,000 exemption from April 24. I mean, this is going to bite the ordinary person, particularly people that have BT shares or Aviva or Standard Life, British Gas, all these things that floated. Do you know what you bought them for? Have you been in rights issues? If you've been in employee schemes and got shares of the company you work for, going forward pretty much from last year, there's not a lot you can do with them without having to pay some capital gains tax. So the good news is you only pay 10 or 20%. It's at your marginal rate of tax. The bad news is you've only got an exemption of 3,000. So John and I have been, the last quarter of the tax year, the first quarter of a calendar year for us is always a nightmare, year-end stuff, but this year in particular is raising the datum points of all our clients' taxable portfolios, doing a bed and breakfast exercise, which we do without any cost, no charges, fees, commissions there, so that going into the next year, we've got as low uncrystallised gains in portfolios as we can. But going forward, even to fund ISAs from taxable portfolios, we may have some problems in keeping within the exemption. So it's something we'll talk to you about, something you've got to be aware of, and it's using the wealth you've got there, but perhaps having to say, I'm going to pay 10% capital gains tax a bit more frequently. And let's be clear, we all pay 20% tax on our interest above 1,000. So we don't say, oh, I'm going to leave it under the bed and not pay tax. We get the interest because we're still better off. We keep 80p in the pound. With capital gain, again, it's a mental thing. Well, if you pay capital gain at 10%, you've kept 90% of the gain and the exemption. And one of the interesting things, I'm going to show you the ONS, the Office of National Statistics website, because we have a dilemma, particularly as I move from CGT into IHT, in advising more elderly clients, what's the risk if you pay some capital gains tax to sell the cottage by the sea so you can reduce your wealth, save inheritance tax and give the money away? But what's the odds of you surviving that 7 years to get that money exempt, having paid your capital gains tax? So this, I'll explain this. You can all do this, by the way. When you go home tonight, Google, when am I going to die? And that's what I did. When are you going to die? And you hopefully get to the Office of National Statistics. I didn't get any other strange adverts. So this is me. It's a 61-year-old, I know I don't look that, man. Here we go. I'm going to die 85. And they've got that wrong. That's wrong. My dad was 97. My mum's 90. That's wrong. I naively think I'm going to go way on. But what this tells me is that really I've got to 78 is the bad news for my kids before I even need to think about gifting anything. And then I'll live 7 years and it's all, everyone will live happily ever after. But let's go to a 75-year-old lady now as an example. Someone that perhaps has done a lot of traveling, enjoyed retirement, typical client, sort of thinking, what do I do next? Well, that lady, interestingly, should live at 75 to 89. So you can argue on statistical evidence that she actually doesn't need to do a great deal with gifting till she's 82. But this is where it starts to get interesting, because why would you want to pay capital gains tax, which you pay, to make the kids better off to potentially avoid inheritance tax? So these sort of dovetail quite well. You may not want to save inheritance tax, it doesn't matter. But if you've got assets that are liable for tax, judging whether you want to voluntarily pay capital gains tax just to save someone else some money is an important decision. And that leads me nicely to inheritance tax. So the level of increase of inheritance tax is huge. The rates have been frozen since 2009. More and more people clearly above the threshold. You can have 325,000 each and not pay anything, the nil rate band. You can have 175,000 if you're giving to children or grandchildren, which is a residential nil rate band. Cross husband and wife, that's where we get to the £1 million. Once you've got more than 2 million, you start to lose that residential nil rate band. So nothing's changed there. All the normal things, I'm not going to overdwell. You've got the normal exemption, 3,000 annual gifts, 250 small gifts for weddings. You've got gifts out of income. Many clients are beginning to use that more. That's regular out of income. Don't reduce your standard of living. That money is immediately exempt from inheritance tax. The pensions, the trusts. Trusts, I can't understate the importance and popularity. Well, we'll set it up as long as we manage it without cost. You'll be in non-income producing assets. And to be able to put a pot of wealth to one side, which is there for grandchildren, but is you or eventually their parents deciding on the release cords, and having had now a 27, a 25 and 22-year-old go through that 18, I'm so pleased that they didn't get their junior ISAs. They've had to prove themselves. They've got to value money. And then maybe granny's funds will come to help with a house as long as they've got income and can get a mortgage. So trusts really do play a big part in this. And I mentioned family discussions. You may have, if you haven't, you've got the quarterly investor newsletter, and there's a brilliant section in that one when you get home about family discussions. Really powerful, and it reminded me of an article that's appeared in the news this week. And this is the Mail Online, so don't ask me where I got this from. Not that I would ever be looking at the Mail Online, but it's from the Mail Online, about a will being disputed. And basically 3 grandchildren of this former soldier that died got £50 each and went to the High Court. So two facts: wills are being disputed far more, and family discussions beforehand should avoid disputes. So there's a double-edged meaning behind this. Check your wills are up to date. Talk to your family about your plans, and make sure when you do your will, if you ever think there's anything contentious within that will, make sure that it's witnessed, it's all done properly, so there's less room for contention. Other little points: the British Savings Bond, very grand name. It all depends what the rate of interest will be. It will be an NSI product, comes in April. We don't know the rate of interest. If it's not around 4.6, it's not competitive at current rates. The triple locks, absolutely. It's amazing how the current government's wedded to the triple lock. Is there an election this year? So 8.5% increases, £221.20. That's about 11,500 a year. We're getting close now to the basic current full state pension being higher than the personal allowance, which means a pensioner has to pay some tax somehow and complete a self-assessment form. So how that will work out, I don't know. Attendance allowance, we've mentioned it to a lot of clients, John and I, this year, as some of our elderly clients are getting a huge amount of care from the healthier member in the family, and there is an attendance allowance. They are saving money from the government doing it. It is tax-free, and it is not means tested. And if you have someone in the house that is needing help, and there is work and effort being done by the other partner, this allowance is there to be had. So the tax burden, as I said, is at the highest level since 1948. Although there's frankly very little change in the budget, you are all paying tax, and there are lots of ways to try to minimize that. So I don't want to overdwell on that any further. Right, let me just get these notes. So the general report and update, I just want to frankly concentrate on St James's Place and the announcements that have been made at 3 separate occasions, 3 separate dates, which I'm going to break down for you, and talk about costs in quite specific detail, and talk about what that cost is and what the value of that cost is. So in July 2023, St James's Place announced their half-yearly figures, which was strong. The year-end figures particularly £15 billion of gross new monies coming in, which was by far across all platforms the highest level in the UK. Net funds of over 5 billion, again ahead of any competitor. So strong figures, but in the July half-year figures, the share price fell about 20%. Why? We announced a cap on the fees of pension products, trust products and investment bond products for those investors who have held those products for 10 years or when they go through the 10-year bit. And we reduced the price at that 10-year point, the product fees by 0.15, by 10% from 1.5 to 1.35. Why did the share price go down? Why did the city not like it? We said we're going to make a lower margin. Our profitability on that line and that growing line of funds under management was going to be reduced. It was what our chief executive and FD said, great news for the consumer, for our clients, not so good news for shareholders. They tried to soften the blow for shareholders by saying we believe that we will retain clients longer because there is a reward for loyalty, and actually it will help attract more wealth. City didn't like the reduction in the short term of the margin, share price went down. Actually, on reflection, and this is an FT article from September, not just talking about what we'd done, but what will go on in the market, was that there's a lot of pressure coming from the Financial Conduct Authority in many different ways for not just financial service providers, but we're speaking about that, to be more cost efficient for consumers, a good thing for consumers. And it was commenting in this article that us with the largest market share, which is a little bar chart on the left, and with mid-range pricing, which is a bar chart on the right, had the advantage of being biggest and therefore first mover. We've got the financial might to be able to do it. And what was the FT article was taking again was a charging base here, which shows in the charging market of wealth management, St. James's Place, if anything, is actually in the mid to lower. Not that you read that in a paper, and I'll come back to that in a second. So that was the first set of sort of analyst feed. When any public company goes to the stock market, it does it formally, and it normally does it every quarter, and that was at the half-year point of 2023. We then get to the third quarter figures of 2023, which were the October figures, again strong figures, but what we did at that stage is we announced that we were going to what's called unbundle our charges. And again, we've been under pressure to do that. We are the only major provider, because we not only manufacture but distribute all our own range of services. Most you have a fund manager, you have a platform, and you have an advisor. And so you have always been used to one bundled set of charges. John and I, when you say, what does it cost? We'll say 1.8, 1.7, 1.9, and the range is dependent on the underlying funds. But underneath that, as we say, there's an ongoing advice fee. The second bit is there's a platform fee, whoever it be with, and the last bit is the manager fee, whoever you invest. So if you are on Hargreaves Lansdown, AJ Bell, Fidelity, whoever it be, you will buy, let's say, a Jupiter fund charging you 0.8 or 0.9. You'll have the platform fee at whatever it is, Hargreaves 0.45, and then if you're giving advice, the advisor fee. For John and I, broadly 0.5 or lower. The FCA don't like that, and we've had to accept, and to our advantage, we're going to go down that route. One, by summer 25, we'll have finished it. It will lower all the charges in entering into that process, which we've taken the decision to do. And importantly, when we're in surveys which compare performance, it will show like for like. Because at the moment, if there's a survey showing the performance of that Jupiter fund, that performance doesn't add to that fund what it costs to have it on a platform or what it costs to be given advice on it. It's just got one bit of the three components, and compared to St. James's Place, you've got all three bits of a component. From summer 25, 2 bits will be taken away, and you'll just see a more direct area. I'm not sure whether anyone will think it's better or worse. It's just what we've got to do. But with it, we're reducing the overall costs, so that will be easier for everyone to see. And then just I think it was last week, we announced our end-of-year figures, which include not just the total gross new monies coming in, the net, it actually is the financial figures. And we reported our highest ever funds under management, our highest ever fees coming in, but with it we announced that we are conducting a review of ongoing advice fees where you, the clients, had not been receiving ongoing advice, and we've made a provision. Now, John and I don't feel this is going to affect us at all, but what is really true and equally annoying, it is clear in the advice world in general that some advisors have been charging ongoing advice fees and have not been providing ongoing advice. And a couple of weeks ago, the Financial Conduct Authority wrote a Dear CEO letter to the 20 largest wealth management companies highlighting this. Again, we are a first mover. We have already stopped with 2%, I think, of clients, 1% of funds under management where the client doesn't want advice. We've stopped the advice fee. But going back, we've recognized and put a provision in our accounts to cover the cost of compensating clients who've been paying for an ongoing advice fee and not receiving it. And we've launched, obviously, a scheme to compensate those people. And we will do the right thing by them. And again, the FCA, the Financial Conduct Authority, I think is entirely right to do this. If you're paying a fee, you should get advice. And that provision, again, surprised the market and led last week to a share price fall. So 3 separate announcements over 3 times about slightly different things. But the bottom line is right now, and I can't disclose where the group's funds under management are, but look at your valuations today, compare them to January, they're higher. Guess what? We're probably at record funds under management even now. The financial position of the group is very strong. The action we've taken, we believe, is market leading. And in one of our competitors' reports just on Wednesday, they announced, in reflection of this letter, that they hadn't yet undertaken a review, but would be doing so, and may have to put a provision in place. So we are ahead, we absolutely believe, of any of the competitors in putting things right for clients. And my lazy fellow partners that haven't been doing a job right will be drilled. It's very, very simple. So those were the 3 announcements, and sorry to dwell on a bit, and I'm going to try and go through this quite quickly, but you pay for a product, what's the value behind the product? So cost is one element of a debate. What is the value you're getting for doing that? Because let's be clear, and where the press use St. James's Place as their target is to say we are more expensive. And if you want to buy a tracker fund on a cheap platform and not get advice, of course we are more expensive, because you're buying a fund that will track and you're doing it on a platform that won't try and add any value and tell you when to move out of one market into another and which fund manager to change. And I'm not saying that's worse, but it's one stage of the value and the advice and the cost argument. So what did John and I and the remainder of the group try to do? We try and give you tax advice. I don't need to dwell on that. I've spoken enough about that today. We try clearly to give you investment advice to make sure that you've got the right risk profile for your objectives. That if you've got different parts of your wealth, one dealing short term, one may be dealing with grandchildren when they're one dealing with medium term, who knows, that we can manage that. You're getting the best returns on cash and interest rates. And we measure that and show you that every review we do by giving you an investor return, plotting to the penny what you started with, what you've had. These people I've used before have taken out £117,000 more than they have ever introduced to the firm, and the value of a portfolio this week was 208,000. As Luke was saying, the power of long-term returns. This lady came to us because she likes running shares, but she accepted post-Brexit in her mind that she was very UK-centric and she didn't have exposure overseas and wanted an income-yielding overseas portfolio. And this week we were able to show her, and it could go the other way, that she was right to have overseas exposure, with her portfolio producing 62% in the last 4 and a bit years from 2019 to the all share index 25%. So again, there's a value argument by listening to clients' bespoke objectives, matching them, and then trying to do something about it. Drawdown in the broader sense is what all of the journey all of you are on. Everyone is on in retirement. You've saved a pot of wealth. When are you going to use it? Are you just going to use it for care? Is it just there to give the children when you inherit of a taxman? Or is it to gradually, whether it be monthly, quarterly, annually, randomly, take money from it? How can you do it and minimize CGT? Keep your income tax as low as possible. Are there cleverer ways to do it? Are there worse ways? What's legislation got to do with it, particularly if you're in pensions? How do you monitor it? How do you pick the right level? Lots of questions. And emotion can get in the way of these decisions if you're doing it analytically on your own. Adding advice, it's shown that investors that use advisors tend, the survey shows, over a long term to perform at 2% per year better than non-clients. Don't know how the hell they've done that, non-advised. But it's all about emotion. I'm afraid if you look at platforms of non-advised, they're people buying at the top are high, the people selling at the bottom are high. And what we try to do, as Luke has showed, is actually take away emotion, look at objectives, keep a good amount in cash, and then you can ride the waves, as Luke ended his talk with. Investment advice isn't then just about getting in, it's about monitoring, it's about diversification, we believe now more than ever, and then obviously will change. And this is your normal Joseph Technicolor jersey or rug, showing you different asset classes, which one is going to do best each year. The answer is no one has any idea, and it's so, so important to make sure you've got very good diversification. And then there's two bits that John and I love doing. It's that more holistic bit. It's the sort of meaning of wealth. It's the way you can add value. Often, I've got clients that are very sophisticated. They know exactly what they're doing, but they want to be challenged. They want to be told why that isn't the right way. They want to debate and argue about the way I or John has shown them to go, because the end decision is more thought out, it's more structured, it's more logical, and then you can go back to it and you've got a very clear pathway. Managing cash is very important. The financial conduct, again, now insists, if we have a client over 85 instructing us, that a child is either present or we involve a child, not to seek their authority, but it's all these vulnerability measures, which are good. It's a double check, and we support that completely, and obviously dealing with more junior family members. And then the last thing is face-to-face advice, and what that means. It sounds dreadfully old-fashioned, ringing an office where someone picks up a phone and gives you their name, and can talk to you quickly, honestly, and even if they can't help you, you feel that they will ring you back or email you or do what you should say. And Mark Fitzpatrick, our new Chief Executive Officer, said to the City last week that we now have more offices around the UK than the largest bank providing branch-based bank there is in the UK. So there may be small little offices like ours in the stables just 3 miles from here, but we are on the ground, and we passionately believe for our target market of clients, they demand and need face-to-face advice. And we've sort of thought COVID would end that to a degree, and doing it all virtually is great. It's good, but it's a second best. There's nothing beats eye-to-eye contact in a room where you're seeing body language and can talk directly and honestly. And the other sort of things we try to do, I talked about attendance allowance, particularly for maybe your daughters or people approaching pension age. Have they got the full state pension credits? The value we can add by just helping a family at the time of bereavement, because we're doing this a lot now. We know what to do. We know people that we can get involved with quickly. We know how we can help make sure there's payments there quickly, that the widow or widower feels reassured. And just being there, as I said, to answer questions, provide peace of mind, or add reassurance. So what are they worth? What is the value of that cost? I'm not going to answer that, but there is a value. And the problem I think that we have in communication is it's something that's quite difficult to put in a succinct article. So every time we are going to be in the press, we know by about Wednesday or Thursday, our communication department is brilliant and will give at least a 2 to 3 page A4 response, and a line will be picked out. And we get very annoyed that, why haven't you said this? Why haven't you said that? Well, we're not the journalists, and I've got to be careful what I say here. We're not the journalists, and they will pick what they want to put as our response. But what I'm trying to say here is we are giving value. We passionately believe. It's for you to determine, is that cost that you're paying worth that, and is the value up to what you need it to be? And it sounds a bit corny. I sort of played around with this, but we do think that despite the share price, the moves we are making, and we believe our shareholders are on our side, painful though they be for our shareholders, will actually be rewarded for our shareholders by you retaining your wealth with us at a lower cost to you, by being rewarded as your wealth goes through the 10-year period, a reward for loyalty, and that it will help John and I to attract new wealth. And that, the testament will be in April when our first quarter figures come in, but John and I know that certainly in terms of instructions, year on year, we're receiving more instructions so far in 23 than 22, sorry, in 24 than 23, but I think that's more about market conditions. So it's corny to say great for private clients, but let me be clear. If you're seeing a cost reduction, I think that's pretty good news. So I hope, you know, I've been through it as clearly as I possibly can. Very happy now to have questions. That pretty much concludes the budget bit and the update on the corporate side. John and I are here, won't delay you, but have anyone got any questions of any form? What I'm going to do is I'll repeat any questions because we're on the YouTube thing so our listeners can hear. Chris.
Could I just ask you about, and I'm sure I'm being way too simplistic about this, but I've written down as you were going along, why has there not been an annual review advice given? Because some people haven't had the annual review. And I believe I phoned this one in a couple of years ago when we were starting to get targeted by lawyers, litigation.
Yes.
See if they could get the
Yeah.
find out if you have been not giving advice. And I immediately referred them as we have been getting advice.
Yes.
I have no complaint at all. But you have said here that some people, some of your partners haven't been given the advice. And my question is this partner negligence, or is it, as you previously described on there, some clients didn't want advice but were given it anyway and charged for it?
Yeah, so just to repeat, it's about the question of people not being given advice in broad terms but having paid for it. I think, like everything, it's retrospective looking as rules have changed, and there was no regulatory compulsion that literally you had to see an advisor and the advisor had to see you every year. So legislation's moved on, and the principle, I think, is fair, that if you are paying an ongoing advice fee, you should see an advisor it's now been defined where it never really had, but it's got to be every year. And there's a little bit of, we're talking here, we're comparing it to something like subscription. So if you've got a subscription to go to the gym, and you've got a subscription to be on Netflix, and you don't go to the gym, and you don't watch anything on Netflix, can you sue them? Well, of course you can't, because you've chosen not to. But in the advice world, that's not going to happen. and we have had problems, and some of my colleagues will have had problems in just getting hold of people that want to see them each year. But that's changed. It's changed. And where it is clear that there hasn't been an attempt to provide ongoing advice, compensation will be paid away. It's as simple as that. And we've got sophisticated systems. It's an American company called Salesforce that now record John and my life within an inch of our daily activity with all client calls and contact. So the evidence is pretty clear, and we've got that going back 3 or 4 years. But the fact is, there will be compensation paid to a number of clients where it is clear that there hasn't been any evidence of them being seen. That will not just be limited to St James's Place. It's an industry-wide thing. Does that answer your question?
It does, but is that a large problem or a minor problem, or
I think
on what scale would you?
Well, the scale thing, and we did a review coming up to Christmas, so the scale we are getting is 1% funds under management is the scale we've monitored so far. So we don't think it's a major problem. For John and I personally, it's just not a problem. We've had vigorous, I've had to talk at partner-led things about servicing and how it's done and the structure. So we just think it's not an issue. And it 1%, but when you're the largest wealth management company, 1% can still be quite a big figure.
Richard, can I just ask you a question? The thing I can't get my head around is that given that most of the advisors, such as yourself, and we're perfectly happy with your advice, are self-employed, and I understand. I can't understand how is it that St James's Place is liable for when an advisor is not giving the right advice?
So the question was, why is St James's Place PLC liable when it's the advisor that's been irresponsible? And the answer to that is, it's about how rules have changed. So St James's Place, up to 3 years ago, did not have a clear-cut rule that you had to go and see an advisor. We've had top world-class marketing people saying your advice should fit what the client wants, not what a regulator wants. And one marketeer very famously stood up and said, I don't want to see someone every year. I will see someone when I want to see someone, when something happens in my life that means I want that to apply. So one, there's been a change, and you've gone from an unscripted regime to very much a scripted regime. So it would be, I think, wrong when there wasn't a regulatory overview by the PLC. But what the PLC is going to do from 2021, I think, 2022 onwards, where the partner, the self-employed partner, is found to have not been following the then updated rules.
That's a governance issue.
Then that partner will be partly liable. Any other questions? None on the budget? We had one lady wanting to buy St James's Place shares this morning. She thought they were undervalued. And her risk profile is definitely not appropriate for that. I don't know if I put her off, but I hope I did. Nothing else on the budget. All the announcements from St James's Place. And what I'm going to attempt to do is we've got about a 3.5-minute clip on YouTube, which I think I can attach to an email. So we'll try and get that out to you early next week, so you could just hear Mark Fitzpatrick saying it as it is as well, which would be nice. And our commitment is, as these things, Summer 25 unbundling and the reviews, we'll obviously be completely in touch. It's been partly covered in the December newsletter. You got an early January. I don't think it's covered in the latest investment newsletter, which is with your budget report. Okay, nothing much else. Well, it's 3:15. don't want to let you... I think there's bits of coffee and biscuits. John and I certainly aren't going to be going off anywhere. You've got your feedback sheets, so the relevance of those is the normal thing. Most of you are brilliant. You do all your tax work at the beginning of the year, but if there's anything that's essential pre-tax year, please tick that. If anything's come out of today that you feel you need to want to get hold of us, please do put that down. Chat with the girls. They're always pleased to see you. It's great to see you all. Great to see everyone on YouTube. And thank you for coming. I hope, as some people said this morning, we get through the winter. Doesn't feel like it. One person said it feels like it's been a long winter. And I think they're right. But the daylight hours are here, pretty much. I hope you have a great summer. Great to help you. On behalf of John and I, thank you for coming and look forward to serving you for the rest of the year. Thank you very much.